Hello and welcome to another episode of India and Global Left. If you are new to the show, please smash that subscribe button. Also consider becoming a YouTube member, a Patreon, or donate small amount given in the link in the description box. But the least you could do is to watch this show, like, share, and comment. Without further ado, let me welcome our guest tonight, Dr. Leah Downey. Dr. Downey is a research fellow at St. John's College, Cambridge, and a co-editor of A Political Economy of Justice. Today, we are having Dr. Downey to discuss her latest book, Our Money, Monetary Policy as if Democracy Matters, published by Princeton University Press 2025. Dr. Downey, welcome to India and Global Left.
Thanks for having me. Happy to be here.
I wanted to discuss your latest book, Our Money, Monetary Policy as if Democracy Matters. And I thought I would I would start by asking you to define what is money, more not in general terms, because there are these econ 101 definitions that money is a means of exchange, it's a unit of account, and it's a store of value. I mean, those things are not wrong, but it often leads to, seeing money as this neutral neoclassical understanding of something floating as a byproduct within the economy. But what is really happening with money is the credit money, which are created by chartered banks and increasingly non-bank financial institutions. And that, I think, is the structure that is behind the book that you are discussing. Of course, the main actors in your book are the Fed, the central bank, and the Congress. But I think underneath what they are doing is this array of institutions that are creating money. So if you could tell us a little bit about what these institutions are, that would be a great start.
Yeah, totally. I think one place that I like to start is to think about sort of monetary policy because I agree that if you start to ask sort of what is money, you can head down these roads where, huge books have been written about this because the real answer is it's lots of things to lots of different people, right? And it can be quite difficult to define if you start looking at it straight ahead. So I often start with my students at least to think about sort of what is monetary policy and in the US, at least, it's pretty clear in the Constitution, the legislature is given the power to regulate the currency and the value thereof, right? And so the idea is that there will have to be some sort of state engagement with determining how we allocate resources, right? And how we engage in trade and what it means to engage in management of the money supply. And so if you think about it through history, right, then you start thinking, okay, that's what we're talking about. And then you start looking at history, again, the book focuses on the US, but you could do this in most places, right? Think about sort of how money existed and how we utilized money sort of early on before it was highly centralized, or at least more centralized in the way that we have it today. In the US, I think the best example of this is we used to have a national banking system where different banks would issue different forms of money, and it was quite difficult to exchange those and to sort of engage in trade at larger distances. And so we started to centralize, right? So we started to say we're going to sort of have a certain currency. The state is going to regulate its creation and allocation, and that's going to make things be more efficient and more effective. But if you follow the story through, right, we sort of tend to assume, therefore, that it's the state that's doing all money creation. But of course, that's not true, right? Because what monetary policy is money creation. We do that, of course, both through the mint, but then also through things like balance sheet policy at the central bank and QE and things like that. But I think equally as important, if not more important today, is the state's role in regulating private money creation, right? And so when banks are offering loans, for instance, or non-bank financial institutions are offering things like loans, they're creating money out of thin air, but they're doing it through the structures of the state, right? So the state is enabling them to do it and it's incentivizing them. That's essentially what interest rate policy is to incentivize more or less money creation at a given moment in time. I mean, I'd be remiss not to mention the work by Saleha Marova and Bob Hockett, who described this as a finance franchise, right? So the franchise structure, where it's the state is franchising out the power to create money to private institutions, but then regulating it over time.
And the regulatory mechanism does determine how much money we would have in the system. And I'm asking this because recently I got into this debate with libertarian scholar Scott Horton, and I invited him, of course, to discuss foreign policy, but we got in this debate about capitalism. And
Mm,
one of his concerns was, which is also my concern, is about this explosion of financial instruments. And I told him that that is primarily because money being created is increasingly the credit money and the non-banking financial institutions money rather than the fiat money he was talking about. And he said he agrees, but that's because he thinks there is more regulation. And I walked him through the 1990s, all the changes that happened with things like Interstate Banking and Branching Act that allowed larger
mhm,
banks to create more money, but also pushing down regulations like reserve ratios and so on. And
mhm.
finally, of course, the Fed using its balance sheet operations like interest on reserve assets and so on, which allows it to flood the financial markets with money, which is needed to save the financial sector. So, would it be fair to say that more deregulation means more money in the system?
I don't think you can draw a necessary line like that, right? Because I think what we can say is that the state is engaged in, as I was saying before, regulating the incentives that private institutions face, but it's not determinative, right? So, like, it's not that the state says, as currently constituted. There are moments in time in which states were more engaged in quantitative and qualitative credit guidance that could put more strict limits on, for instance, amount of credit issued in the system. In the under current sort of practices, especially in the US, that's much less the case, right? We could reintroduce something like that, which may be a very good idea. I mean, I think to your point about sort of this explosion of, to my mind, the quantity is not really the core issue. It's what it's being used for and how it's being allocated. And those things are super intertwined, right? And, again, sort of to go to an analogy I often use with students is it's sort of like, it's not so much, how much money you've borrowed. It's, are you borrowing it to go to Vegas for the weekend or are you borrowing it to go to law school? And those things are obviously hugely different and they're related to the amount because, it doesn't matter if you borrow $100 to go to Vegas for the weekend, but it does if you borrow 50,000, that kind of thing. So I think that they matter, but to me, the regulatory connection is less. I mean, it is about deregulation, but it's primarily about the international system, in my view, at the moment, right? So, we're essentially creating a second non-regulated financial system through the proliferation of the Eurodollar market, in my view, since pretty much the mid 70s, it's really exploded. And essentially, what that is explicitly is people around the world wanting to use dollars and hold dollars, but not wanting to have the state regulation that typically, even the minimal state regulation that typically comes with holding US dollars. And uh, and that's an issue, and not only because of the proliferation, therefore, of the sort of credit that's existing and money creation that's existing outside of the US and in the US, but in the form of Eurodollars. But even in my view, more importantly, how that undermines the capacity of the state to deploy these sorts of powers, right? So both to control them from a sort of prudential perspective, but also just to employ credit creation and steer credit creation as an arm of state capacity. And that's really sort of the center of the book, right? Is to say, look, monetary policy and the power to regulate the creation of money is hugely important if and important specifically to democracy, if what we think the point of a democracy is in a democratic state is to produce and reproduce the world that we live in, right? And if that's the case, what's more important than that, than steering how and where we spend money, right, going forward? And that's essentially, in my view, what credit policy is. And so, part of the argument in the book is from a democratic perspective, saying the current arrangement is less democratic than it should be. But the other part is a sort of state capacity argument, right? Which is the state could be doing a lot more and could be a lot more effective if it sort of grasped these powers more head on.
Yeah, I think it's important to emphasize that more money creation is not necessarily bad, because it's no one would argue that creating a liquidity crisis is good. In fact, you need money to lubricate your economy as long as it is going into the real economy. But I do think that neoliberal capitalism that we are talking about, the enormous explosion of money, is because of the over financialization, which is linked to this all these financial instruments. You can talk about the stock buybacks, for instance. Companies doing stock buybacks to pay its dividends to its shareholder means they are relying increasingly more and more on borrowing and leverage financing,
Mhm.
which has meant an explosion of credit effectively. One can also talk about the explosion of the repo market, which is
Mhm.
effectively because of whole range of financial instruments, including the correlations of the repo instruments with the housing market and so on and so forth. So I think I think there is a point in saying that the over financialization has led to enormous disproportionate explosion of money, much of which is probably not needed if we are talking about the kind of going to either law school or Vegas. I mean, both of them are relatively more benevolent than what we are seeing in the world of that financial casino. So I understand that you are making a distinction between Vegas and
Mhm.
the law school, but I'm saying that both Vegas and law school are probably much more benevolent than what we are seeing within that financial sector casino.
Yeah, I think you can make that argument. I suppose as I see it, there's sort of two levels of argument one can make about this situation, right? One is and the one that I t try and focus on in the book, which is the sort of argument about the balance of power. Who's in charge? Who's making the decisions? Who should be making the decisions? So legitimacy questions. Who has the effective capacity to make those decisions when they are the ones that should be made, right? So, for instance, the large part of the book is saying, look, the legislature really should have the final say on monetary policy. And in technical, formal, legal capacity, they do, right? In theory, the legislature could tell the Fed to do something different tomorrow with a majority vote. My argument is that they don't any longer have the sort of effective power to do that, right? After essentially setting down and attempting to get rid of that responsibility for, the last 100 years. Um, so that's a sort of structural argument about the balance of power to make these choices, which in my view is kind of where you have to start. And it's also a way to get into this conversation that isn't immediately partisan, which is, I think, kind of important because the structures are broken. Then the secondary conversation, in my view, is okay, now let's assume that we sort of fix the structures such that that people who are meant to have the power have the power. Then the question is, what do they do with it? Right. And there, I think that you have a very compelling argument to suggest, right, that the wrong decisions have been made, for the last, recent history, at least in the US. And this deregulation has essentially, I mean, my favorite quote about this comes from, oh gosh, is it Leontiev? I think it might be Leontiev, who argues, right, that, sure, capitalist sort of market-based system can really power an economy. It's the wind in the sails of a sailboat. But if you don't have a rudder in the form of government steering, then your boat's just going to blow around. You're not going to be able to get anywhere that you want to go. And essentially, this is sort of what I hear you saying, right? Which I think is right. Which is, we've got this hugely high-powered capitalist financial system in the U.S. that is going to innovate and it's going to try and make money. And if you don't put boundaries on how you can legally do those things, then you're going to end up with the proliferation of sort of meaningless financial instruments, like making more and more sort of complicated financial trades to meet the sort of profit-driven, but also statistics-driven sort of metrics that we have, rather than actually getting into the gritty of sort of producing goods and services for people. And that the connection you're making, it sounds to me, is that regulation is the thing that can do that, essentially. And my argument is, yeah, I think that's probably right. But that's about the sort of what should we be doing, rather, who has the capacity and should have the capacity to be doing that, essentially.
Yeah, I think we'll keep that as a background to enter the book a little bit more directly. The Fed is one of the central protagonists, or I should say, an antagonist of your book. So, of course, you talk about several roles, both formal, but also what it de facto does, even from price stability to creating employment to creating moderate interest rates. But effectively, there is an impression that it just ultimately homes down on price stability. But it also does more than that. It keeps the financial sector alive, and that is its capacity enormously increased after innovation of new instruments like interest on reserve assets and so on. If you could tell us why was the Fed such an important actor in your book, I think that would be great.
Yeah, definitely. I mean, so we were talking earlier about what monetary policy is and the sort of regulation of money creation and the sort of public and private money creation. And really, the Fed is the institution that is responsible for doing this in the US. And in my view, um, prior to writing this book, when I was engaging with a lot of the literature and political theory on finance and money and monetary policy, people that talked about democracy in relation to these topics tended to focus on income inequality or wealth inequality, which is, of course, extremely important, but in my view, doesn't go far enough to understanding the relationship between money and finance and democracy. And it relates to something that I was saying before, which is that in my view, democracy, sorry, is about a lot more than just distributional concerns, right? So it's not just about who has what, where, and how, or who gets what, where, and how, as one famous definition of politics would put it. But politics is actually, in democratic politics and specifically, is about the capacity to self-rule, to self-govern. And what that means, in my view, is that means having the capacity to steer policy such that we have some sense of control over creating the world that we live in and recreating it over time, right? And so, if that's the case, as I believe it is, then I agree with some very basic political science views that say that both military power, so the power of sort of monopoly over legitimate violence, but also money creation power are fundamental to the state, right? And so, in my view, the capacity to create money and to allocate it and thereby determine what in practice gets done in society, what gets produced, what gets studied, what gets repaired, who gets supported, and so on and so forth, is just simply foundational to the power of a democracy. And so that's what I was concerned with. And if that's what you're concerned with, there's only one place to go, and that's the central bank. And which is why the Fed was the centerpiece of my investigations. Now, that's partly because I'm American. I was studying the American state. It's also because, as you know, very well know, the Federal Reserve has become de facto the central bank to the global system. And so there's multiple reasons to focus on not just central banks, but the Fed in particular when one's thinking about this kind of thing. So that's how I got started there. And it just went from there. I mean, I think that one could study the Fed endlessly, really. It's a really fascinating piece of the US government. I mean, just to mention one other thing, I mean, it's probably the most independent administrative agency in the US government. And that itself is a fascinating thing from a democratic perspective, which of course I discuss in the book.
And what does it get wrong that you think your method, which is effectively the more democratic method, and you pin your hope on the Congress? And I want to discuss that a little bit separately, like to what extent one can do that. But to the extent that the autonomy or the dominance of the central bank as something as a technocratic institution insulated from popular views, um, what does it get wrong by having that view that we are a set of expert who looks at macroeconomic stability or overall macroeconomic growth? Maybe we are not good at the distribution question, but then you have the fiscal arm to do that. And so we are getting it right. I mean, that is what would the central bankers would argue over and over again. And what would be your response to them?
Yeah, great. So there are quite a few things that one could say about this. I mean, so yeah, essentially, I think you could read the entire book as an answer to that question. And on the one hand, I sort of take the typical arguments in defense of central bank independence and suggest that they're actually not as strong as people say that they are. And so we could go through that, right? So, the classic defense of that is of central bank independence is either that monetary policy is too important or too complicated to let politicians take care of it. And in fact, we need to put it in the hands of independent experts. And also because politicians are sort of too short-sighted to have the right answers. So we need these experts to deliver good monetary policy. I mean, we can go into detail as much as you like on these things and my challenges to them, but essentially I say what is good monetary policy is far from clear. The capacity of these experts to actually deliver good monetary policy consistently over time, far from clear, given the historical evidence and also the theoretical arguments. The fact that monetary policy is sort of uniquely complicated or uniquely important, also far from clear. It doesn't seem to me more complicated necessarily than, military policy, environmental policy, tax policy, any of these other things where we actually insist that democratic leaders are in charge of what goes on. And that underlines this other point, which is that what I argue for in the book is not to eliminate the Federal Reserve, right? It's not to get rid of experts at all in their entirety. Quite the opposite. I think experts and the administrative state are essential pieces of a strong, healthy democratic state. Rather, it's to make sure that we're employing expertise rather than being ruled by experts. And so the effort is to create a system in which the legislature maintains ongoing and effective power to steer monetary policy and to engage in the questions of how are we doing it and how could we be doing it differently, but not to simply sort of give in to what I call central bank dominance under the current regime, where it's really the Fed that's calling the shots and not the legislature. So that's kind of one piece of the book, which is to say the arguments in favor of central bank independence as they currently exist are really just not as bulletproof as people seem to think that they are. And I sort of go through those carefully. And then the other part of the book, from the more democratic theory perspective, is to say, and not only are the arguments in favor of central bank independence not as strong as we might have thought, the arguments against it are actually really quite strong, right? And so this is the claim that if we sort of delegate monetary policy, something as fundamental as monetary policy, to an independent agency, consistently over time, and have the legislature essentially stick its fingers in its ears and say, we're just not going to deal with that. You actually, what that leads to is an atrophy and an ossification of the legislature's power to engage in that matter. And so even if 20, 30, 40 years down the line, the legislature thinks, oh gosh, maybe we should be doing something about that. The muscle to actually understand the what's going on there, what could be different, and the balance of power relationship between the legislature and the central bank is totally off kilter. And so you're undermining really the health of the democracy over time by engaging in that form of monetary policy governance, is what I suggest, at least.
One of the things that struck me, I mean, your comparison with military affairs or environmental policies and so on and so forth, I think one of the things that kind of distinguishes monetary policy from them is that underlying monetary theory, there is this huge dogma of neoclassical economics. So it's later become neoliberal, et cetera, et cetera. And you do mention this in your book that it's underlying what the Fed does or gets it wrong is not malevolent intention or people who are not necessarily equipped to do that, but a fundamental sort of dogmatic belief in what monetary policy is. If you could tell us a little bit about that, how neoclassical theory creates a dogma about its understanding of money. One can, of course, think about Milton Friedman's whole calculation of overall money and how he claimed that it remains more or less proportional to the overall economy, and what he recommended, effectively sort of saying that any attempt to use monetary policy to do structural change in the economy would be detrimental in the long run. You, of course, challenge quite rightly that the very idea of long term is so absurd. It can be like 2 months, it can be 20 years, or it can never come. If you could tell our viewers a little bit about that dogmatism of our standard theory.
Yeah, definitely. I think this is one of my favorite parts of the book, or it was one of my favorite parts of doing this research, is to just take the time to articulate what is what doesn't make sense about the theoretical backbone of this picture, right? So behind the idea that we can have an independent central bank that is pursuing good monetary policy, quote unquote, and what good monetary policy is narrowly defined, is an idea of monetary policy or monetary neutrality. And as you say, it was one that Milton Friedman endorsed, amongst many others. And the idea is essentially this, that the amount of money in the economy doesn't have any meaningful, lasting effect on what the economy can produce, right? And where it produces. Because what determines that is how much labor and capital and technology that we have. Those are the fundamentals of the economy. And all money really does is sort of enables trade and gives us prices, right? So the best way of thinking about this is, if you make tables and I make cups, right? What determines how many tables and cups we can make is labor, capital, and technology. And all money will do will price those things for us, right? So say one table is worth 10 cups, and all of a sudden there's twice as much money in the economy. Then, one table or two, then you'll have two tables and 20 cups or whatever it is. The relative price won't change, but the nominal price will, based on how much money is in the economy in the long run. Now, in the short run, of course, too much or too little money in the economy can cause problems, right? But the idea is that those problems are only sort of surface level, right? So they'll cause sort of frictions and issues, but over time, the fundamentals of the economy will be what really matters. So this is Friedman's suggestion that all monetary policy can really do is prevent money from being a problem, right? So if you make sure that you smooth out those short run potential issues and just cruise smoothly to that long run, then you're doing the best that you can do. So the analogy I use in the book to describe this is to tennis, right? So monetary policymakers should be like ball boys or ball girls at a tennis match. And what they should do is make sure that the players get the balls when they need it and that there are no balls on the court when they don't need it, such that the tennis match can be conducted to the highest ability of the players and most effectively and efficiently. If the ball boys were to all of a sudden throw a bunch of balls on the court when they're not meant to be there and somebody trips or, they can't play the game, that's causing short-term disruptions, right? That's what monetary policymakers shouldn't be doing. Now, I think that this is a pretty crazy idea of reality. It's, of course, makes theoretical sense if we're talking about things as if we're living in a world in which there's a short run and then we achieve the long run, which is not in calendar time, right? So the long run on this view is not 10, 20, 30, 40, 50, 100 years from now. It's when we re-achieve equilibrium. And equilibrium could come about like instantly, and then we're in the long run immediately. It could come around in 10 years, it could come around in 100 years, it could never come around. And that's probably the most likely scenario because in the interim, something else has changed. So we never achieve that original equilibrium. So if you're using this as a thought experiment, in a Marshallian sort of way, and you're thinking about what is going to change in a given equilibrium, sure, it makes sense. But if you're thinking about reality as a policymaker, about what might be the case in 2 years and 5 years and 10 years, this idea that money is neutral is pretty damaging in my view, because of course it has an impact on production and what we can actually produce and where who gets the credit to engage in the research and development, who gets the money to build a new factory. The idea that that's all going to sort of come out in the wash in a reasonable sort of calendar time period, it to me seems very, very unlikely. And I think, and this has been somewhat recognized in the literature, in the sort of formal economic literature on monetary policy, particularly by, I think, particularly well by Claudio Borio and some of his co-authors, where they suggest that monetary policy, that there are more sources of what is known as hysteresis than perhaps was previously recognized. And what hysteresis is, it came out of some work by Larry Summers and others, where they were talking about the labor market, Blanchard as well, where they essentially said, look, if you go into recession, and people go out, like lose their jobs, then it's not necessarily obviously the case that as soon as the economy picks up again, those people can pick up jobs like this because their skills may have, atrophied, things may have changed, the jobs may be in different places, they may not be as easy to move, et cetera, et cetera. And so what essentially that means is that if monetary policy allows that recession to occur in the first place, it could actually have lasting effects on the capacity of the economy over time. And essentially, what I'm saying is that must just be true all the time about monetary policy, right? Because monetary policy affects what we produce and who produces what. And of course, wouldn't we think that that would have implications for production over time? So sorry, I'm going on and on, but I find this topic really fascinating, and it is absolutely foundational to the picture that we can take monetary policy, we can pull it apart from fiscal policy, we can give it to an independent expert, and all they have to do is make sure that there's no short-term problems, and then we'll achieve optimal production. This is the sort of secondary theory that based on monetary policy neutrality, we can have divine coincidence, where if central bankers secure price stability over time, everything will be hunky dory and great. And I just think that that is very, very implausible.
Yeah, I guess this whole barter model of economy, it gets two things particularly wrong. One is the equilibrium, which it assumes and it never happens. And so there are these time lags in which the real economy operate. And the second, I think, is it doesn't take credit seriously. And so
Yeah.
it just keeps away the whole distribution question almost entirely out of the window, because just doesn't matter whether I would get a student loan or a mortgage loan, or whether big corporations would get loans to pay its shareholders through buybacks. Okay, I think I want to ask you about democracy, because that's sort of the, I would say, two pillar on which the book stands. One is the monetary policy, the other is democracy, and you try to bring them together, saying that, well, democracy is what should determine what monetary policy is. So democracy as a concept is incredibly vague, and I might be unpopular for saying that, but that's one reason why I refrain from using that too much. So tell us about what your democracy look like here, and how would that be able to lead us towards a better monetary policy that would that would work towards the people rather than these big private capitalists.
Yeah, it's a great question. And you're right. There's a huge amount of scholarly literature and popular discourse about democracy and what it means to democratize and what is democratic and what is not, et cetera, et cetera. And I try and sidestep a lot of that in the book by essentially saying, look, regardless of what theory of democracy you adopt, however thick or thin, it seems to me that any reasonable account of democracy, and there are some that I would view as unreasonable and not to fall into this category. But I think any reasonable account of democracy has to recognize that democracy should be a system of self-government. And in my view, what that means is citizens have to directly or indirectly be able to steer policy, right? And so in most modern states, right, we can think of that as being indirect capacity that goes through elected officials. So, supposing we adopt that pretty thin basic assumption that citizens have to, through elected officials, have the effective power, the real power to steer policy, that already gives rise to this picture that I'm trying to paint in the book, where there's a tension between that thinnest form of democracy and the form of governance we have over monetary policy today and central bank independence as it's currently constructed, because central bank independence as currently constructed is intentionally meant to insulate policymakers over money from elected officials. So then you have to go down the road of saying, like, okay, two things. Well, one, is that true, right? Like is it true that the legislature doesn't in fact have like good, healthy, thick power over monetary policy? Because as I've mentioned before, they could vote to eliminate the Fed tomorrow. And this is where my argument is, yeah, but you have to think about this over time, and you have to think about it as the effective capacity, not just the formal power to do something. And I suggest that in the sort of structure of independent central banks and independent agencies more broadly, over time gives rise to the waning or the atrophy of the legislative capacity to in fact enact these powers. So that's one thing. And then the other thing you might say is, okay, but shouldn't the legislature be able to self-bind, right? Shouldn't they be able to say, actually, we choose to delegate this power to an independent central bank because we think it's going to be the better move. And therefore, in a certain sense, that's the democratic choice, right? That's the legislature choosing to self-bind. And here, the most common analogy that you see in the central bank literature is Ulysses, right? Or Odysseus. And the idea that the legislature should be able to bind itself to the mast of central bank independence to deliver good monetary policy in exactly the way that Ulysses bound himself to the mast of the boat, so to be able to sort of get past the sirens. And here, I think it's really essential to underline some fundamental disanalogies, right? Okay, so one is the legislature is not binding itself to the mast in any reasonable way, as to compare it to Ulysses. So Ulysses says to the crew, tie me to the mast so I can't untie myself, right? Well, the legislature hasn't done that. They could, as I just said, they could vote to eliminate the Fed tomorrow if they wanted. So they're not actually bound in any meaningful sense. To do that, they'd have to make constitutional change, right? So that's one thing. The second thing is that if the legislature does sort of, in essence, sort of, I think, as I say, I think it's more like sticking your fingers in your ears than being bound to the mast. But in either case, if the legislature does either of those things for an extended period of time, its effective capacity to govern is going to wane, it's going to atrophy. So, and to put it in the language of the analogy, the best time for the crew of Ulysses's boat to want to mutiny would be after Ulysses had been tied to the mast for 20 years, right, and hadn't engaged in any sort of captaining in that time, right? So he's not going to be a great captain at that point, and they're going to be super empowered having done it for the last 20 years. So that's the second point. And then the last important bit of disanalogy between these two things is that Ulysses is tied to the mast and not doing anything because he's tied up. Whereas the legislature is throughout this period wanting to do all kinds of things, wanting to legislate, wanting to, pass bills that increase jobs, that support certain types of government investment or, economic activity in certain regions and stuff. All of which is related to monetary policy. And so you can't pull these two things apart in the way that the analogy seems to require. So my point is that the the central bank independence picture that we see, and this idea that it is actually democratic for the legislature to bind itself to central bank independence to deliver better policy, as we already discussed earlier, there might that the reasons to do that might in fact not actually be as strong. But even when we talk about the sort of democratic credentials of doing that, I don't think there's anything illegitimate about making a choice like that. I do think it's potentially endangers the health of the democracy over time to choose not to engage one's power and sort of let it atrophy. So I suggest in the book an alternative, which I call iterative governance, which is the legislature regularly engages in steering monetary policy. So it knows and regularly shows its power over the central bank, such that the balance of power between the legislature and the bank itself remains what I would call the sort of proper balance in a healthy democracy.
And you discuss the two tools would be one setting a credit policy through what you call as the preferred asset taxonomy, I guess. Could you very briefly talk about that tool? Is it in its very crude form, is it the Congress saying the Fed that, well, here are our priorities in overall credit policy. You can still look to the markets, you can still look to the private sector, the financial sector, but here are a couple of things that we might set priorities because we have to win elections. Like, okay, I'm caricaturing, but is that what you were saying, or is it deeper than what I'm saying?
It could be that. I mean, part of the way that I wanted to design it was that the point was to have the legislature engage on a yearly basis in publicly declaring.
And just to interrupt, because I just wanted to add real quick, because in India, for instance, we do have something like what you suggest there. We have
Mhm,
something called as the priority sector lending.
mhm.
So the parliament does say the central, and through the central bank, the banks, the scheduled commercial banks, that you have to allocate like 20% of credits to all these vulnerable sectors. I just wanted to place that on the table because it does it does speak to what you have been discussing in your book.
No, yeah, exactly. No, I was going to mention it myself because it's fascinating. It's a fascinating example. Um, and in a, it's not perfect, but in a certain way, sort of proof of concept of the fact that central banks can engage in this type of thing. And of course, there's other historical examples. I mean, Eric Monet's work on France is fantastic on this. And it's true in many different states, including the US, that and this was more explicitly recognized in sort of the 70s, but central banks are engaging in credit policy already, right? They engage in, as we've already talked about, incentivizing or disincentivizing money creation, which happens through banks, and they also directly get involved through balance sheet policy in buying and selling assets. Through both of those things, they shape the way that credit is allocated in the economy. And essentially, what the suggestion is, using the preferred asset taxonomy, is to force the legislature on an annual basis to take responsibility for that. To say either, great, you're doing a great job, do it, keep going, do it exactly as you are doing, and sort of no comment, right? Like we'll just sort of keep going. Or the legislature could say, actually, we don't love how much credit's going to this region or to this sector or to this type of person. We want to see more here, we want to see less there, etc. And in the book, I detail in a little bit more specifics about how they could articulate that set of preferences, and how it could either be quite elaborate articulation or very broad or very minimal. Because what I don't want to do is sort of force a particular politics here. Rather, what I want to say is I want the legislature enacting its own power, whether that be, as I say, to endorse the current system or to make changes. And the idea, I mean, one way that some people find it, I think, useful to conceptualize is, if you think about the annual budget process, it enables the legislature through the budget process to comment on the actions of certain administrative agencies, right? But of course, the Fed doesn't have to go through the budget process for obvious reasons. It makes money. So this is sort of an attempt to put it into that style of relationship with the legislature. This reform, the sort of preferred asset taxonomy, which I talk about potentially pairing with differential asset-based reserve requirements, is an effort to give the legislature more power and responsibility and active requirement of declaring those things over the way that monetary policy is conducted within existing tools, right? And then I'm sure we'll talk about this, but the second proposal is about giving that power to the legislature over the actual structure and tools that the Fed has at all, right? So I want the legislature to feel empowered to change both the operation of monetary policy and the sort of institutions and structures of monetary policy, and to be forced to reckon with that responsibility and make a public choice about it after public debate on a regular basis.
All right. We have a little bit under 15 minutes, so I guess I will have two main conversation. The final would be your last two chapters, which is on the sort of global economy, and it would be nice to talk about anti-globalization a little bit at a time when we have the tariff wars and whatnot. But before that, if we could spend like 3 to 4 minutes on a let's say a challenge that I felt for reading your book, and this is like all in good faith. I think I like what you are saying. I wish that the Congress or, any legislature would have more power. But at the end of the day, I think you are, let's say, being a little bit naive because you are thinking that the legislature would be democratic, while we know that the very class that put their people in the central banks is the very class that put people in the legislature. It's the asset holding class that sends the same people, same class of people, from socioeconomic background, indoctrination on economic theory or how to look at politics and economics. So these are effectively, as long as we are under capitalism, and I don't want to come up as a fatalistic person that as long as we don't have socialism that we can't do anything, but just to pose as a challenge to what you are saying. Why would those people who are going to the legislature by picking up money from all the, JP Morgan Chase and, Goldman Sachs and the Black Rocks and all the asset holding class, why would they be directing money towards poor immigrants coming from Venezuela to open a small business or to get an educational loan to send their kids as first generation learner rather than saving I don't know, like the credit, the gamblers in the financial class, in the financial sector.
Yeah, no, it's a great question. And there's quite a few things to say about it. So let me see if I can organize them well. So the first thing I would say is that often I get a form of this question, right? And the sort of more brazen, you were very gentle and kind in the way you phrase it. The more va brazen version is sort of like, seriously, you want to empower that like bag of crazies that are entirely dysfunctional that like sit in the US Congress? Isn't that ridiculous and completely and utterly naive? And so I think there's a few, as I say, there's a few things to say about it. I mean, one is I think one could make two arguments that suggest that the reason that we have the legislature that we have, in part, is because of how we're doing things, right? So one form of that argument is this, which is that you have a lot of people being elected in recent elections off the back of a widespread sense of disillusionment about the government, that it's not acting in their interest, but more importantly, not their interest, it's not acting as they want it to act, right? Not how the elites think it should in order to serve them, but how they genuinely have said, I want X, Y, and Z. It's not going and doing that. And whether that's because it's unwilling to do that, elected people are unwilling to do that, or they feel unable to do that because of the structures of the state, right? And things like these independent agencies. So there's this idea that that democracy, as I described it really early on, the very basic sense of democracy that the people either indirectly or indirectly should be steering policy, has fallen apart, right? They're not actually, they don't feel that power. And part of that, I argue in the book, is because we've disconnected so much actual policymaking power and delegated it to the independent, or not even just independent agencies, but administrative state, away from the legislature, right? Or the legislature's effective control. So that's one argument about why maybe this legislature is starting to be full of people that it is, right? Is because these are sort of protest votes. The other is that the style of legislation or legislating that you get when you delegate power away from the Congress, right? So if Congress says, okay, everything we can delegate away, we will, what's left is either something that's very contentious because you can't even agree on a form of delegation, or it's all sort of performative, high level discussion, right? So if you say, sure, we can all agree on clean air, let's create the EPA, or we can all agree on price stability, let's create the Federal Reserve. What you get then is loads of people in Congress sort of not really engaging in the real difficult politics of the trade-offs and the assumptions and the decisions that are necessary to actually create policy to try and enact that kind of thing. And therefore, you get a performative politics. politics, right? That's sort of, well, I voted for clean air and I voted for price stability and so-and-so's didn't deliver it. Or why don't we build a wall and make Mexico pay for it? And, let's let the administration figure out exactly how to do those different things. And so these two things combine where you get people who are very blustery and sort of angry in the legislature, and the structure of politics, one that's very performative, and it doesn't make you want to give them more power because they're acting like crazy people. So that's one thing to say. The second thing to say is that the book focuses on, I discuss in the book what I call the chain of delegation, right? So political power traveling from citizens to elected officials, from elected officials to the administrative state, and in certain instances, like much monetary policy, from the administrative state to the private sector. And the book really focuses on the second chain, right, from the legislature to the administrative state and how that fits into a broader picture of a healthy democracy. But as you very rightly point out, that's one link in a chain that is all essential for a very healthy democracy. And in the US right now, that first link is hugely broken. I mean, from the citizens to the legislature, I mean, we all know it, right? Nobody talks about it all the time because it's sort of like this depressing thing we all know, and it's not sort of, there's not much more to say, which is that campaign finance law, but also gerrymandering have entirely corrupted that first link. And so you're right. In the book, I largely set that aside because there's a hugely compelling and correct, in my view, political science literature on why that's totally undermining of a healthy democracy. And it is a prerequisite, I think, along with what I argue for, to establish a healthier system. But the last thing I would just say is that with the slight addendum of um, if we were to implement my suggested policies, like we would have to abide by what Congress thinks is the right thing to do. That's what democracy means. And that is risky. And for those people who are in the elite who are benefiting from the status quo, right? This would be risky because things could easily change. But that to me is sort of the name of the game when it comes to democracy.
Yeah, this reminds me of an interview where Noam Chomsky was once asked, like, why should we support democracy? And his short answer was, it's a value, it's categorical. I mean, I'm sure he could have said, like, 10 different ways why democracy is more utilitarian, why democracy would lead our policies to be more effective, and so on and so forth. But he never bothered to answer, saying that it's categorical. I mean, yes, it will come with very bad things, but ultimately you have to deepen your democracy. There is no shortcut to that, or technocracy as an alternative to democracy, even if we sometimes have horrible policies through democracy. But yeah, you said it right, that a healthy, functional link between people and legislature should exist in order to your policies being more effective. I think real quick, since you need to go in 5 minutes, I think the last two chapters talk about the global economy, and I think I liked your definition. I don't know if anyone else has used it, but you are saying the whole global economy is basically I don't remember the exact phrase, but a constellation of asset holder. It's an asset holder economy or something like that. Um, and it's an interesting moment where the whole idea of globalization has been rethought in several ways. There is a trade aspect of it, which progressives are trying to defend because of very many reasons, and then there is the whole financial aspect of it, which I think you attack, and I think most people on the left or many on the right would also agree with you that that has largely served the interest of the global financial elite. So, would it be fair to be a bit provocative to say that you are an anti-globalist and you are saying that it is nation states that have to be strengthened, and forget about these Bank of International Settlements, WTO, IMF, World Bank, blah, blah. They are not going to work and it's a long shot. Maybe we can talk about them when they would be there. But for now, the immediate necessity is to make nation states more powerful, and it is then we can make Congress more powerful vis-a-vis the central bank, because right now the central bank has to serve the interest of the euro dollar bond market, and so my thesis fall aside, and so democracy fall aside.
Yeah. I think for me, I mean, the way I describe it in the book is, as you're right, is that we're essentially living under a system of global governance currently, right? When it comes to finance, and that global system of governance is rooted in domestic independence of central banks, right? Because the domestic independence of central banks allows the central banks to commit to this global decentralized governance network. And of course, we don't have global democracy, so there's no real sense, I think, in which that global system of governance can be described as democratic. So if we take the sort of question of the book very seriously and literally, monetary policy as if democracy matters, then democracy has to become more domestically controlled. Yes, I think that's true. Now, what I think is important to say is that that doesn't mean it has to be isolationist, right? So what that means is in the same way that I argue that making domestic monetary policy more democratic requires establishing effective control in the legislature, right? But that doesn't mean eliminating expertise at the Fed. The same thing I think is true when it comes to international policy, right? So it means establishing effective control of policy in the domestic legislature. But that doesn't mean the legislature can't choose to have trade deals, to have cooperation with other states, to have multilateral engagement. What it means is you have to structure that such that the balance of power retains, that the domestic legislature can choose to change things, can choose to change its mind, can engage on a regular basis with steering that policy. So you don't have indefinite forms of pre-commitment to global regulation like we do now, which, as you say, is largely driven by the interests of private asset holders because of the way that it developed historically and how it's structured. And so I do think that sustaining a healthier democracy will require more domestic control, but that doesn't entail necessarily isolationism.
We'll leave it there, Dr. Downey. That was lovely talking to you about your book, and thank you so much for your time.
Hi, my name is Ayushman. I, along with Jyotisman, have started this platform. In the last 2 years, we have tried to build content for the left and progressive forces. We have interviewed economists, historians, political commentators, and activists so far. If you have liked our content so far and want us to build an archive for the left, I have two requests for you. Please do consider donating for the cause. Link is in the description below. Also, if you are not able to do so, don't feel sad. You can always like our videos and share our videos to your comrades. Finally, don't forget to hit the subscribe button.